All right, let's jump right into this explainer where we are putting AI networking giant Ciena through the absolute ultimate financial stress test. We're going to see exactly what happens when you take the legendary old-school investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham and force them to evaluate one of today's hottest AI high flyers. Let's find out.
Here's our roadmap for today. We've got 1. The Ciena snapshot, 2. The Buffett lens, 3. The Lynch lens, 4. The Benjamin Graham gauntlet, 5. Discounted cash flow and alternative models, and finally, 6. Synthesis and final verdict.
Kicking things off with Section 1, the Ciena snapshot.
To start, we really need to understand why Wall Street is so obsessed with this company right now. The core thesis is actually fascinating. As cloud providers and hyperscalers are essentially in an arms race to build out massive AI infrastructure, the demand for Ciena's optical networking tech is just exploding. Think of it like this. They aren't just riding the AI hype train, they're literally laying down the digital highways that allow these massive AI data centers to actually communicate with each other.
But to figure out if all this technological hype is already baked into the stock, we have to anchor our analysis to reality. As of our data snapshot, Ciena's closing price is sitting at $374.41 a share. That gives it a massive $53 billion market cap. So the real question we're answering today isn't just, is this a good company? It's, is this a good stock at this specific price?
Look at this underlying business momentum. It is undeniably staggering. In their Q2 2026 results, they pulled in $1.57 billion in revenue. That's a 40% year-over-year jump. Direct cloud provider revenue, up 70%. And check out that adjusted earnings per share, $1.64, which is up an insane 290% year-over-year. Add in a robust $7.7 billion order backlog, giving them incredible visibility into the future. Plus, they're securing massive contracts with major cloud providers. This is a business that is absolutely firing on all cylinders.
Moving right along to Section 2, the Buffett lens.
So how does the Oracle of Omaha view an AI infrastructure stock? Well, Buffett's whole framework is about high-quality businesses bought at reasonable prices. He would absolutely love Ciena's economic moat. Their clear technology lead and widespread adoption by top enterprise customers shows a true competitive advantage. And they easily pass his quality checks, a solid 15.59% return on equity and a very manageable debt-to-equity ratio of 0.54. But then we hit a brick wall. With a free cash flow yield of barely 1.5% and a nosebleed PE ratio over 124, there is literally zero margin of safety here. Buffett would definitely admire the business, but he wouldn't touch the stock at this price.
Next up, Section 3, the Lynch lens. Let's see how growth-focused legend Peter Lynch handles this exact same data. Lynch loves to put companies into buckets, and Ciena firmly lands in his favorite one, the fast grower, thanks to that 40% revenue surge and 290% earnings growth we talked about. The crucial metric here is the PEG ratio, which is just the PE ratio divided by the growth rate. A PEG under 1.0 is considered the holy grail for growth investors. Because Ciena's earnings are growing so explosively, its PEG ratio is actually a stellar 0.74. So while Buffett runs screaming from that high PE, Peter Lynch would see a stock whose tremendous growth entirely justifies its current price tag.
All right, brace yourselves for Section 4, the Benjamin Graham gauntlet.
Benjamin Graham, the father of value investing, doesn't care about the flashy AI narrative. He only cares about cold, hard assets and conservative valuations. Running Ciena through his defensive investor checklist, they actually passed the size test with that $53 billion market cap. They also crushed the financial condition test. Graham wants a current ratio over 2, and Ciena boasts a 2.73, meaning plenty of short-term liquidity. But step 3, massive fail. Graham strictly limits investments to a P of 15 and a price-to-book of 1.5. Ciena is sitting at a PE of 124 and a PB over 18. It is completely off the charts for a classic value investor.
To see just how far off the mark we are for a traditional value purist, we need to quickly run Graham's legendary intrinsic value formula. It calculates fair value based on a multiplier of 22.5 times earnings per share times book value per share, all under a square root. So what's the actual number? Well, since the raw EPS and book value data weren't directly laid out in our primary snapshot, we had to do a little detective work. By reverse calculating them from those PE and PB ratios, we cracked the code.
At a price of $374.41, a PE of 124.49 implies an EPS of roughly $3.01, and a PB of 18.33 implies a book value of about $20.43 per share.
Plugging those numbers into the formula, Graham's model outputs a shockingly low intrinsic value of just $37.19. Talk about a reality check. This is a fascinating lesson in valuation frameworks. It proves without a doubt that classic value purists who rely strictly on historical assets simply won't touch a modern AI momentum stock. I mean, for Graham to even consider buying, Ciena stock would have to crash by a devastating 90%.
Let's step out of history and into the present with Section 5, Discounted Cash Flow and Alternative Models.
We're going to run a modern quantitative DCF valuation, which values a company based on the actual cash it will generate in the future. Now, because the DCF looks ahead, we've got to be upfront about our assumptions. We're leveraging that massive $7.7 billion backlog to model really healthy cash flows over the next 5 years. We're applying a 10% weighted average cost of capital, basically our discount rate, which is pretty standard for a high-growth tech stock. And we're assuming a conservative 3% terminal growth rate to match long-term economic expansion.
The most crucial takeaway here is how sensitive these numbers are. Under our base case, 10% discount rate, 3% growth, the fair value hovers right around $415, meaning the current $374 price tag is actually pretty fair. But look at how volatile this gets. If Ciena grows just a tiny bit faster at 4% and the risk discount drops to 9%, fair value rockets up to $550. Modern DCF models show us that if the expected growth materializes, today's high price actually makes total mathematical sense.
And this brings us to what modern Wall Street analysts and alternative forecasting models are seeing as they look past the next couple of years and gaze deeper into the AI-driven 2030s.
If Ciena can actually sustain this multi-year AI infrastructure supercycle, meaning they remain the absolute backbone for data center interconnects, alternative models project staggering upside. The current Wall Street consensus is already at $484, but forward-looking platforms like Ticker, which map out a sustained supercycle all the way to 2030, suggest an incredible target of $1,187. I mean, that is a massive, almost unbelievable divergence from Benjamin Graham's $37 valuation, right?
Bringing it all together now. Section 6, Synthesis and Final Verdict.
The stock has officially run the gauntlet, and this synthesized data perfectly captures the wild divide in the financial world right now. Backward-looking, traditional value models like Graham's are screaming at you to run away. But forward-looking cash flow models, analyst consensus, and supercycle projections are yelling that it's still deeply undervalued despite the seemingly high entry price.
Ultimately, your investment decision comes down to one specific dynamic. Ciena's undeniable strength is that this unprecedented AI infrastructure demand is funneling billions into their backlog, driving a 40% revenue surge. But the core risk? With a 124 times PE multiple, this stock is priced for absolute perfection. Any hiccup in hyperscaler spending, and that multiple is going to compress violently.
Therefore, our final blended verdict splits the difference. If you're a Graham or Buffett purist, it is a firm avoid or hold. You're waiting for a massive pullback before even thinking about a position. But if you're a Peter Lynch disciple, a DCF modeler, or a modern growth investor, that explosive earnings growth and low PEG ratio likely categorize this stock as a very confident buy.
I want to leave you with this provocative thought to take away from this explainer. As traditional valuation metrics seem to completely break down in the face of this once-in-a-generation AI infrastructure boom, which legendary investor's philosophy will ultimately be proven right? Will value gravity eventually pull Ciena back down to earth? Or will this explosive growth make today's high prices look like an absolute bargain down the road? Think carefully about which lens best matches your own investing style.